But, we hope to use these gatherings as a way of thinking about what questions do we need to answer that we're not, and how should we go about answering them? And maybe I could start by simply saying, a lot of the things that we've heard today reinforce my perspective on risk management and policymaking and how businesses should behave. And I've been involved in all of that stuff. But I think that one of the big things is that when people think about risks and what can go wrong, they can't be deferential. And one of my bosses used to say to me, this was the Secretary of the Treasury, don't be deferential. I want to hear the bad news. Well, guess what? Bad news is hard to convey, particularly when you're not quite sure that it's really bad news. And so you need to be truthful about what you know, as Don said and Mervyn said, about what you know and don't know. We talked a lot about resilience today. We didn't talk much about recovery, but I think that's also an aspect of the way that we should think about the consequences of identifying and managing risk, because things can go so wrong that people can fail. And so what does the recovery look like? And I think that's particularly important for central counterparties, but it's also important for the rest of the infrastructure in our financial system and in our economy. And that brings me to think about one of the things that software engineers talk about a lot, but don't always do, which is building in resilience by design. And when we think about the regulatory framework, we need to think about how to be aware of the unintended consequences of certain regulation. And so there are a couple of good examples of that, like the ESLR, the supplementary leverage ratio, and its unintended consequences for the risk in portfolios, how we trade off leverage versus risk-weighted assets in terms of capital requirements, and those related things. I just want to keep emphasizing the need to have appropriate communications. And in terms of compound risks, I didn't get to ask a question, but would like all of you to think about how should we aggregate when we've identified each of these things and possibly their interplay and convergence. How do we think about aggregating those risks? How do we think about communicating the sum total of those things? We don't want to reduce it to just a simple number, as Casey was saying we probably don't want to do, but we do want to make it possible to communicate the totality of those risks, so that we think about what can go wrong. I do think that we've got a useful structure in identifying, for example, threats to financial stability. We think about vulnerabilities and shocks that can expose them, and I think that speaks to Don's point about resilience. We may not know all the shocks that are and all the bad things that are going to happen to banks, non-bank financial intermediaries, and to systemically relevant markets. But we want to make sure that they're resilient enough so that when those bad things happen that we weren't aware of, that they can live to fight maybe another day. Rob, what are your thoughts?
Well, I think it's been a great day, actually. It seems to me that what we have identified today is that this idea of compound risk is even more important maybe than we thought, that the idea of there being different stress scenarios and multiple kinds of stresses and so forth is omnipresent, and we, I think, feel like it sounds like we're likely to see increasing numbers of stress scenarios being used. And what are they going to be used for? Well, it seems to me if they're going to be used for learning about where the stresses are, that might suggest a different kind of stress scenario. It might suggest stressing just one sector rather than a whole path of everything, just looking at what happens if foreign exchange does this, and what happens if something else happens? So if it's really, these are designed for educational purposes, maybe we do them set them up a little differently. That, I think that's kind of like an experimental design idea, that, you know, if you're going to do random experiments, then, you know, let's construct them so they cover the space a little bit better. I don't know whether that's really possible or useful, or, but it's interesting. Then they could be combined to give I mean, you could think about taking linear combinations of them as being something like what you think really the distribution is going to be. Anyway, I think as soon as we start talking about it this way, there are a lot of interesting possibilities. I remain interested in, how do you assess the probability of any one or many of these scenarios? How do you assess the joint probability of a bunch of them, or maybe it's a linear combination of them, if I'm thinking about it that way? If we're going to use it for capital adequacy, do we have to commit to which scenario we're going to use? We have one that we're going to use, and that's the one for capital adequacy. Well, that doesn't seem to make sense either, because we don't know which scenario to propose for that. So if we're going to use it for capital adequacy, we might have to maybe tailor the strength of it so that it is a reasonable, it's reasonable to expect a bank to pass, you know, half a dozen or a dozen different scenarios by making them each not quite so strong. Well, there's a lot of thinking about how you would actually do that. I mean, I think the kinds of tail risk things that I did are potentially part of the answer, but it's obviously more complicated than that when you get to the kind of scenarios that we're talking about. We've seen. Oh yes, you know, Renee had a couple of interesting points that I wanted to mention. That he was looking at compound risks across countries, and I think that's kind of interesting too, because we might be doing our stress test in one country, and are we taking for as given what's in the other country, or are we going to stress that country too, and then have the feedbacks to us? You know, those would be different answers, and it might give us a little bit more justification for policies which actually support the other country if you are getting the spillovers coming back. I think one of the important questions is, what do you do with the information from the stress test? Are you going to adjust, you know, risk buckets for your different branches of your company, or do something else? If you just increase your capital buffers, is that enough? I would think basically the idea might be it's not just resilience, it's also being smart about risk return in different parts of the business. And then of course that means you need a return equation too. But sort of an overall comment which I thought came up over and over today was, you know, this has been a bad 3 years. And could we have anticipated this? And the answer, I think, is surely no. But the other side of it is, well, we haven't, I mean, we're not out of it maybe yet, but it hasn't really been that bad. So what's the implication of that? Even without anticipating it, we sort of wrote it out, or maybe just the policies were adequate or possibly excessive in trying to, in helping us deal with it. In any case, I think it wouldn't be bad to talk a little bit about why we're not in worse shape now than we ought to be, given the stuff that's all happened. In any case, I think it's been a great day. And I learned a whole lot, and I think there are lots of things to be done and said in this area, and I hope we can make a contribution.
So thank you all for coming today. Thanks for your wisdom, and we hope to keep engaging with you to learn more.